help us understand what's happening at the macro sort of level, right? Because there's obviously been this long conversation. I've been speaking with you and listening to you speak on this as well in terms of inflation, higher rates, and all of a sudden the banking system seems like it's not liking what the Fed has been up to. So help us understand what's playing out in the macro space and in terms of like what central banks are doing around the world.
Thank you, Uzair, and thank you very much, everyone, for joining. So, I guess let me start with what is happening right now, and then we can take a step back in terms of charting out, what are the sources of these shocks. I'm sure there'll be a lot of debate and discussion once this crisis settles down, hopefully. Just now, the news has come in that UBS has bought Credit Suisse and wiping out almost entire their equity, which is good news, at least that credit the CS credit will be protected. So I can explain a little bit the relevance and importance of that. So right now, what we are facing is a trust shock. This is very different from 2008, 2009, which was a confidence shock as a result of potential credit losses. This is a trust shock driven by the tightening in interest rates, which was the second largest tightening in terms of pace and magnitude since the 1980s. We as a house and myself have been flagging that this for a couple of years, that this is a very dangerous development because debt to GDP ratios are so high and the system may not be able to cope with this kind of aggressive tightening. That said, of course, the key central banks have been focused on inflation and the massive misallocation of resources which happened after COVID shock, which was done on the basis that interest rate will probably remain low and zero forever. So there was a massive misallocation of resourcing which happened both at a macro and micro level. And now this is showing up in unexpected ways, but ultimately through this trust shock, as I mentioned. So with SVB, of course, lots have been written now by now on the idiosyncratic issues which were prevalent in the bank. The problem with banking sector is that it's a systemically important sector. So I say that in a provocative sense, but if Facebook gets wiped out from the face of the planet overnight, nobody will care from a macro perspective. I mean, your money is not locked into, say, Facebook. It's just that you lose your network and you can, populate another one in coming days. That's not how banks work. So even though there were some idiosyncratic and mismanagement issues with SVB, the problem is that it creates a trust deficit in the whole sector. And that triggered another idiosyncratic story in Credit Suisse, which was under pressure for a while now due to mismanagement and other things, and then more generally on the regional banks in the US. So the idea is very simple. If you are a depositor above 250K in one of these banks, why would you take the risk of keeping your money in those banks? Yes, the Fed has and the FDIC have come in and given them liquidity and protection ex post, and given you a cocktail of acronyms. But apart from the wholesale market in finance, really nobody understands exactly how this bailout works. If you do, put a haircut on it because it's a very complicated subject, and it's difficult to calibrate, and a lot of that is done through leverage, and confidence is the key behind it. So no bank can sustain deposit runs, so bank runs. So there were a lot of bank runs in the 1800s in the US. And that's why FDIC came into being. Then Federal Reserve came in after the global, the Great Depression. So there's a whole history behind trying to secure banks and making them more, stronger. So zooming out and taking a few steps back, as I mentioned, this inflation fight, which was important, but was done in a way which ignored the financial stability risks of tightening so fast. Our view is that we are already in that territory where this will do a lot of damage because this tightening was done on planet Earth, not on planet Mars. So somebody will have to pay the price for it. And there's a lot of losses sitting in the system as a result of the increase in interest rates. The question is who realizes the loss and who explains it. And then, and in this case, there has been a bank which triggered a deposit run. So this is not by no means over. The only solution to my mind is an unlimited deposit guarantee, which the regional banks are starting to ask to stabilize that confidence and that trust back into the system, because it's fundamentally very different from 2008, 2009, when you were talking about credit issues and NPLs. This is more to do with losses coming from what you have in your what you call trading book versus what you have in your hold to maturity books, which are backing these liabilities when you look at the bank balance sheets. So all in all, we need government backstops which are unequivocal. Unfortunately, this time around, this is not the wholesale market which is involved, where the Fed can give liquidity like it has, because the discount window usage is gone through to $300 billion, and overall Fed has expanded balance sheet by $500 billion. Us on the wholesale side can see it, but I'm not quite sure that will stabilize the sentiment of the person on the street who would, can electronically transfer money out of the bank in seconds. So this electronic banking technology is also a challenge right now, because it can create a run within hours on some of these entities. So the speed is an enemy here, because it doesn't allow stability to come into play, and that's why I think a clear-cut, unequivocal protection for the depositors, which has its own issues like moral hazard and others, would be needed to stabilize confidence in the banking sector, especially in the regional banks in the US. Last point I would mention, I'll go back to you, is more generally on asset markets. The transmission channel is now on credit tightening. So we are expecting credit standards to tighten quite significantly. We do expect investors to become very clear and very focused on what works and what doesn't work, and the penalties will be much higher, both from a risk premium perspective and also this idea that you are passing the parcel, especially in some areas of the market, that may start to slow down as cost of funding rises and access to funding becomes a problem. So that credit standards loan survey data is very highly correlated with bank CDS and bank share prices. So we're expecting a significant credit crunch to come through as a result of this shock, which is yet to play out fully, and it will depend on if the political environment in the US will allow this overarching backstop to come into play to restore trust back into the system. So I'll pause here and give the floor back to you, sir. Thank you.